Hello, Linda and Taylor. Thank you again for meeting with us here at Cash on Hand LLC. We were so pleased to hear that you enjoyed our recommendation for your costing system, and we were very pleased to continue working with you on your proposed two options in front of you, that of working with the fast food contract or switching to increase your bottleneck capacity by investing in a new labeling machine. We've evaluated these two alternatives in terms of the criteria you suggested, which are the strategic value, the risk implications of the two options, the technical implications of the two options, and lastly, the financial aspects. What we've got for you today is an evaluation of the opportunities in front of you. You have on one hand option 1, which would be going with the fast food contract, or option 2, increasing your bottleneck capacity by investing in the labeling machine. My team will now walk you through our evaluation of the alternatives based on the criteria, and then we'll come back and we'll talk about how we can proceed with our recommendation of pursuing option 1, the fast food contract. We will begin our discussion of these criteria, starting with the strategic analysis. Let me introduce you to Mr. Kirkwood, our strategic analyst.
When looking towards the strategy of Humble Pies, it's important to look towards the SWOT analysis. If you refer to Appendix 1, you'll see a list of strengths, weaknesses, opportunities, and threats. Your customer support moving forward is going to be your backbone, given any opportunity that you take, and is your strongest strength. As far as weaknesses go, seasonal sales account for 60% of your total, meaning reduced cash flows in the off-season. For opportunities, you have a huge opening for market development. And as far as threats go, competition in this new environment will be huge, and there's a possibility of people copying your product. At this point, it's very possible for you guys to compete on a national level if you are able to achieve the scale and the capital to do so.
Thanks, Andrew. Now let's go see Mr. Joyce about the risk and technical implications of our options.
My name is Charles Joyce, Lead Financial Advisor for Cash on Hand LLC. Please step into my office. Discuss some of the technical factors associated with the two options. Both of them include purchasing new equipment, which will have a learning curve for employees, as well as figuring out the nuts and bolts of the new processing line. Option 1 additionally has the introduction of a new product. This will include research and development, as well as increased training for employees. There will also be negotiations with suppliers and the contract. In order to make a business decision, risks are going to be involved. Option 2 is the riskier decision, as you're not really changing anything. You're staying status quo and relying on your organic growth. The only problem you're facing is the capacity issue. Now, option 1 is a lot less riskier, as you are solving the cash flow problem, creating a constant source, and also opening up possibilities for the future.
If you'll kindly join me in the conference room, we have a financial meeting to discuss the options with Mr. DeMarco and Mr. Joyce.
When assessing the financials of the two different situations, we looked at two different metrics in order to determine which project would be the best. The first metric we looked at was the net present values of free cash flows. This is an effective metric because it takes into account the substantial depreciation along with the tax shield. The tax shield is the result of the difference between using the accelerated maker's depreciation for machinery and the straight line depreciation, which we assumed you use in your books. The next metric we looked at was return on investment. This deals strictly with the profitability and when each investment will break even. If you see in Appendix 4, under the second option, there's never a positive ROI. In doing some hypothetical calculations, we found out that it would take about 7 years to experience this positive ROI.
So you'll notice when looking at the financials for option 2 that there is a positive NPV of cash flows. However, the return on investment never actually breaks zero and becomes positive. This is primarily due to the free cash flow and profitability differences, which is the depreciation line item which is added back in. This creates for a positive free cash flow while keeping profitability below the investment.
As you can tell from the decision matrix, option 1 is significantly more favorable than option 2, driven mainly by the significantly lower risk of signing on to the fast food contract and earning those steady cash flows, and the far increased financial performance. So now that we agree that option 1 is the best choice for Humble Pies, you need to begin planning on what you can do tomorrow to work with these objectives. First and foremost, you need to begin training your employees, not only in the baking and filling of mini pies, but also training on the new equipment that's coming in, so that you can begin to efficiently operate the new packaging machine. Also, it's imperative that you begin your external communications, working with the fast food company to make sure that the details of the contract are sealed out and that you agree and will work together well. After the 3-year contract has elapsed, it is going to be time again to review your options and consider whether or not you want to pursue extending your contract with a fast food company, or perhaps upping your process capacity and pursuing your own independent projects. So we've given you a thorough analysis, examined the options, and come to the conclusion that option 1, the fast food contract, is the best choice. Thank you, and we hope to do business with you again in the future.